All attendees are in listen-only mode.
Welcome everyone to this webinar at Admiral Markets. So glad that you could join us on Thursday the 15th of August, and we're going to take a look at importance of chart patterns. I welcome you. My name is Chris. And
my name is Nenad. So hello everyone.
And there's Tarantula. Great.
Yep.
And I think Michael will also join us today. Not sure if he's present at the moment, but he will be talking as well later on. So with that said, we're going to take a look at the importance of chart patterns. But before we do that, just a quick explanation. Of course, this is Admiral Markets. And if you're not aware of that, take a look at the website, www.admiralmarkets.com. I think I said one W too many, but you get the picture. Great spreads, for example, so definitely worth your time. After this webinar, take a look. Of course, the risk disclaimer explaining that trading foreign exchange and global financial markets is considered high risk and may not be suitable for all investors. Please seek the advice of an independent financial advisor for more information on that. And this video and webinar is for educational purposes only. So thanks for your attention. Thanks for your attention on that one. And we're going to take a detailed analysis on how to use chart patterns. For those of you who might be wondering, I know chart patterns. I think we're going to still have some interesting and exciting stuff to show you. Also realize that it does definitely take a lot of experience to recognize them. You have to practice it, go back in past, and just look for these patterns. Pattern recognition, very important part of trading as well, very useful part of trading. And just by going back into the past and looking actively for them, I'm talking about maybe even hundreds of patterns before you really get the feel for them. So definitely worth your time and effort. So we're going to be taking a look at what are chart patterns, why do they appear, a review of them, of course, but also the interpretation and how to trade them. So we're going to take a look at a lot of stuff. But first of all, of course, what they are. And Tarantula will give a guidance there, I think. Are you there, T?
I have muted my microphone because there was some noise in the background. So yeah, we are going to start with what are chart patterns. Basically, I will explain what chart patterns are and how we will use them. After that, we will show you some examples on the charts, and Chris will show you how to trade those patterns. So chart patterns are just a reflection of price action in a given time. So they appear constantly on our charts, no matter the time frame. They can even appear on M1 time frame, but of course the higher time frame is, the more significant chart patterns are. So we basically want to see them at least on M15 or 1 hour or 4 hour time frame if we want to do some intra-week trading. But I prefer to see it on 4 hour, on 1 hour, and on 15-minute time frame. So chart patterns are patterns, and those are formed within a chart when prices are graphed. So we need to have a trading station. We cannot do that without our charting platform. So it's very hard to do it on our mobile phone, like for example, some 10 years ago by pen and paper trading. It's basically impossible. So we want to have a charting platform because we need to connect those trend lines. We need to see that. We need to use our common sense. Chart patterns are used only in technical analysis. So they are pretty neglected in fundamental news trading because fundamental trading does not have to do anything with technical trading. So we purely use it in technical analysis. We can use it also, as I say, to project price action and to react. Project price action means that we can use it to determine our target points and our target price. And we can determine it to see where the price will go. So another thing is we can use it to react. So Chris will show you later, after successful retest of a pattern, we can enter a trade. So we don't use stochastic, we don't use any other confirmation tool except those patterns. So we can use it to react and to project price action. So also they can be either a reversal or a continuation signal. So there are patterns which signal a reversal, like some sort of double tops, double bottoms, and triangles, but also a continuation signal, as there can be also a flat top ascending triangle or flat bottom ascending or descending triangle. So everything which have in common with patterns can be useful to us. So don't neglect the power of head and shoulders, the power of W, of M, and by proceeding further, you will see how we use it to trade. Why they appear? Why do they appear? Basically, they appear naturally. Now we don't want to talk about harmonic patterns. Harmonic patterns are another trading strategy which can be exploited, but today we won't use any harmonics, butterflies, bats, or so on. We will talk about those classical chart patterns. So they always appear naturally because they are a reflection of price action. They will appear every day, no matter the time frame. The thing is that triangles and flags appear during indecision market and accumulation or distribution, excluding flat top and bottom ascending and descending triangles. What does that mean? I will try to explain you in short. Basically, for accumulation. Accumulation is a phase of a market cycle where big boys and big banks are positioning themselves before the trend starts or during a break of the trend, for example. So they need to build market position of several $100 billion. So to make it happen, they have to do that over several days. That means that the price will create either a triangle or a flag. So due to the large size of accumulated positions and money, price will usually go against the position. So if, for example, they are building position with a trend, a flag is created. If there is, I'm talking about accumulation phase, because every time and each time the place to position in the market, and even if it goes against the position, the market will retrace. So even if it goes against the position, they will exploit the retracement. So that is what I call trading the retracement. And that is how triangle works. Flat top ascending or flat top descending. For distribution phase, when we are done with the trend, so we don't have the trend anymore, we will normally see some ranging patterns. And those ranging patterns represent that big boys usually lower off their positions. So if there is a runaway market, for example, against the trend, it normally means that big boys try to immediately go out of their position due to some fundamental shifts. And that creates large volatility. Distribution phase usually happens after the accumulation phase. Accumulation phase is triangle phase. We will see some triangles, we will see the price going close to the vortex of the triangle, and after that, breakout will happen. That will be the trigger, either for fundamental shift. For example, today, you saw the reaction of euro-dollar after the news. That was a breakout, and that breakout always creates large volatility. So those patterns reflect traders' decisions. And if you read the analysis I have posted earlier, I told you that 32.75 is the big level. We didn't have any specific pattern today. But for example, let's say that was a sort of rectangle. I will show you a rectangle pattern later. So when that level, 32.75, was broken, the price went to test 32.30 and then proceed further to 32.05. My projection was 31.90, but we still have a chance to go to 31.90 because this price action looks, for me, this looks bearish, even though we had a retracement of some 60 pips. So always try to watch what big banks are doing. And by looking at patterns, you will see that those traders' decisions. So patterns reflect always traders' decisions. Basic chart patterns are symmetrical triangles, flat top triangles, flat bottom triangles, rectangles, flags, and pennants. Those are basic chart patterns, and they appear almost every day, especially those symmetrical triangles, which indicate accumulation phase. Flat top triangles, flat bottom triangles are usually continuation chart patterns. Rectangles are also some sort of accumulation phase before the distribution, heavy distribution. Flags and pennants, you will see. We will explain each of them. So those are basic chart patterns. And so let us start with basic chart patterns. Yes, and later we will show you advanced chart patterns. So the first patterns we usually see is triangle. So this is an example of classical triangle. So it's a symmetrical triangle. And what are triangles? Triangles are commonly found in the price charts of Forex market, basically. But they can also be traded as in stock market, bonds, futures market. So the pattern derives the name from the fact that it is characterized by a contraction in price range and converging trend lines. So it gives us a triangular shape. So triangle patterns can be broken down in several categories: ascending triangle, descending triangle, and the symmetrical triangle. So the shape of triangle is important because it usually gives us the cue whether we will trade a breakout or a continuation. So triangles can sometimes be reversal patterns, but they are normally seen as continuation patterns, especially ascending and descending flat top, flat bottom triangles. So in this example, we see that this is symmetrical triangle. We have been talking about this many times before. So what does it mean? We are waiting for the breakout close to the vortex of the triangle. After the breakout, we wait for retest, and then we go for continuation. In this case, we can see how retest has been made. A perfect example of a successful retest of a triangle pattern. So there has been a breakout, and after that, there was a successful retest of the pattern. So we see that the price proceeded further to test a lower support. That was an example of euro-dollar. So this was a breakout, this was a retest, and then the price went down to 30.75. Okay. So next slide, again, I put a slide of symmetrical triangle, but you see, sometimes those triangles won't make a retest if the volume, I'm not talking again about classical volume, about tick volume, and about orders. If there were heavy orders placed, we won't see any retest. The price will proceed further down. But sometimes the retest can happen a few hours later. So in this example, we can see how the price went down without the retest, and then it was retested on this spike up. So that was a retest before further continuation down. So sometimes, especially after the news, this can be a little tricky to trade because we cannot get into retracement, and the price can deceive us. Like in this example, maybe because this is 1 hour time frame, in those hours we traded, maybe we thought we were thinking the price will be bullish again, especially after this price. But the thing is, this was a retest which happened some couple of hours later. So breakout of triangle can be either with a retest or without a retest. I prefer a retest, but you can also be a trigger happy trader. So you want to see and exploit a full breakout of that lower trend line. So this was an example of symmetrical triangle. Now we can see some advanced chart patterns. Some advanced chart patterns are, let me show you this. This is you will see later. Head and shoulders, inverted head and shoulders, megaphone, cup and handle, broadening top, diamond, and W123 and M123 pattern. We won't talk so much about, for example, this cup and handle, because this pattern, this is theoretical pattern, but I don't use it because it really, for me, it's not significant. The two best advanced chart patterns for me are head and shoulders and inverted head and shoulders. Megaphone or broadening top is very tricky pattern, and I don't like to trade it. If you followed my analysis, we had several megaphones some time ago, I think it was some months ago, and I really don't like to trade it. Also, one of my favorites is W bullish and M bearish pattern. Those are advanced chart patterns, and you will see how you can exploit it. So the next slide is this is a good example of a wedge. So this can be viewed as one pattern which commonly shows on higher time frames. It can be shown also on lower time frames, but on higher time frames, a wedge is very important. In this example of a wedge pattern, we can see that the trend was building to the upside. So we can see that the trend was building to the upside. And after that, we see that we have a lower trend line which is not symmetrical as a triangle. We have a lower trend line and we have upper trend line. Those trend lines are not symmetrical as in triangle. And the biggest difference is they don't have a vortex. There is no vortex at the peak of the pattern. So there is no vortex. So this is a very common pattern, and that can be traded after the breakout of a lower trend line. So this pattern is characterized by this shape. This is characteristic of a wedge. Trend lines are longer. Lower trend line is important because we want to see a breakout to the downside. After the breakout, you see how wedge reverses preceding trend. You see, it was a bullish trend and a wedge was reversing preceding trend. And after the breakout of lower trend line and retest, the price should go down. So this is a great example of a wedge pattern and how it can be traded. So if you spot a pattern like this in uptrend, you will know that this is a wedge in uptrend, and that signals a reversal pattern. So you don't want to build long positions, you want to go short. So that is example of a wedge pattern. Another good example of let's say continuation pattern is a flat top ascending. Flat top is because we have a double top. If you see this pattern, you will immediately know that this is some sort of continuation signal. Why? Because you see the price, it went to test 4 times this top. 4 times this top. It was going down, down, and many traders would think that the price will go to the upside, meaning that the trend will shift to bullish. But if you see this pattern, no, you won't go and you won't buy into resistance. You will wait for the price to retest a lower trend line and go down. So this is flat top ascending triangle, but this is a flat top is usually a sign, it's 80% chance of sign of a continuation. This is a pure example of continuation signal. And yet again, we can see how the price reacted to that lower trend line. We can see after this quadruple top, price has broken the lower trend line, retested it, and went lower. And those patterns, if you spot a bearish trend on 1 hour time frame, you can switch to 15-minute time frame. Or if you spot a bearish trend on 4 hour time frame, you can wait for a pattern to appear on 15-minute time frame and trade it. So you trade the pattern always. You can trade it concerning higher time frame trend. So if higher time frame trend, like in this example, is bearish, 1 hour and 4 hour, we switch to M15 and find a continuation pattern. And many traders use only and solely those patterns to trade Forex market. So you can see how the price reacted to this flat top triangle and how it broke the support and went down. So this is a pure example of that pattern. Now again, we can see some unsuccessful attempt at flat bottom descending. But you see this trend line is descending. So it's giving us a signal to go short probably, because this pattern is descending flat bottom triangle. You see we have a bottom, but this trend line is descending. So we want to see a continuation again. So the price failed to jump at support, and this was a very, very big support, and then it went down, and it almost went down without any retest. So flat top descending triangle, as you can see, is a great example of a successful continuation pattern. So you can see the bullish trend, and then it was reversed to bearish trend, and after that you see a successful breakdown of lower support, and then the price proceeded further. So you see how the big move was, because there wasn't any retest. So this is a flat bottom descending triangle. This is usually a sign of continuation. Flat top descending triangle. Next thing is, how can we exploit breakout pullback continuation pattern in flat bottom again descending triangle? A previous example was a breakout without any retest, but now you can see it. There is a breakout to the downside, and there is breakout pullback continuation. Price went was broken down, so the support was broken. Then the price was retesting that support of descending triangle, and then it went down. If you see this pattern, go in, because this is a very common pattern, and this is really can be used in a continuation mode, for example, bearish trend. So descending trend line, important level to the downside, and again breakout pullback continuation pattern. So you can exploit that if you know how to trade breakout pullback continuation, and we really, if you know, we talked about breakout pullback continuation. So that was a flat top descending, flat bottom descending, and this is rectangle. Rectangle is a common pattern which is very tricky to trade, but you need to know the overall bias of the market. This is a cable, and around 55 the cable was bearish. So after those moves we had some sort of consolidation. This rectangle shows us a perfect example of top and the bottom, and now we wait for a breakout. The chances are, if the preceding trend was bearish, the price will break out at the lower levels of rectangle and go down. Because the price was indeed bearish, the price went down and it was broken. You see how rectangle was broken, and even there wasn't a good retest of it, because the price went to the half, to the 50% fib after this move, and retested 50% and went down. So you see how this rectangle pattern showed us a good example of trading breakouts. So the price went down, there wasn't a big retest, there was only some slight retest of so-called 54, 60 level that indeed wasn't so big, but for some traders it was big, and then the price went down again. So how we trade rectangles? We can trade it either by placing an immediate pending order after the breakout happens, or for our chances to be bigger, if you want a bigger chance of success, we want to trade it just after the retest. So we want to trade it just after the retest. So that is a good example of rectangle. Now we can see some flags, and again rectangles and a symmetrical triangle. Pointed with arrows are bearish flags. To the left is a rectangle, to the right is symmetrical triangle. So what are basically flags? Flags and pennants basically are short-term continuation patterns that mark small consolidation before the previous move resumes. So those patterns are usually preceded by a sharp advance or decline with big volume, big ticks, and mark a midpoint of the move. The flag pattern is usually drawn by two parallel lines. So these lines can be either flat or pointed in the opposite direction of the primary market trend. So the pattern is seen usually as the market potentially just taking a breather after the move before continuation. So flags are continuation signals. You see preceding trend, and those are best exploited on 4-hour time frame. You see the preceding trend was bearish. There was a flag after that move, and we need to wait for the flag to be broken. After the breakdown of this flag, this is bearish flag. Both flags are bearish. You see the move. Then the move was again to the downside. Again consolidation, again some breather. So this is called a retracement. But we still see a flag in a bearish trend. So we again draw those two encompassing parallel lines, and then we wait for the lower trend line to break. So the best thing is to wait for the price to break the lower trend line, and in that way you can exploit the full potential of the bearish flag. So this is the only way how bearish flags are traded. The one and only way. There is no other way. This is bearish flag. So those flags are bearish. You cannot trade it, the breakout to the upper side. If you see this, you wait for the price to go down and break the lower trend line. If that doesn't happen, okay, you don't trade it. And in this example, we can also see a symmetrical triangle. If you remember, some 15 minutes ago, we talked about consolidation phase. You see, this was a consolidation phase after the breakout to the downside, and then this is a consolidation in the bearish trend. So we would favor a breakout to the downside, and the breakout to the downside happened after the break of the lower trend line. So symmetrical triangles are patterns in accumulation phase, and flags are just a retracement, and bearish flags are known as retracement in bearish trend. So they are bullish in their nature, but behind the mask, behind the curtains, flags, those kind of flags are very, very bearish. So those were flags, and now you can see some sorts of flags and pennants is the same. So I wrote flags and pennants. So you need to know that those are basically the same thing. The same thing, flag and pennants. Wedges are different. So bearish pennant or bearish flag is you can see to the left side is the first example with the retest. This was example. This is an example with the retest. You can see the breakdown and then retest and continuation. And after that, we can see a bullish pennant. So we can see a bullish flag. You see, it is a downtrend, but if you spot a bullish pennant in downtrend, that is a retracement. That will mean that the retracement will be bigger. So you will enter after the retest of the upper side. If you see bullish pennant, it's characterized, of course, in a bearish market. But that will mean that this retracement will go higher. So you can exploit the retracement after the breakout of upper trend line and the successful retest. So this is a bullish pennant, and that to the left is bearish pennant. Then again, to the right side, we can see a bullish wedge. You see a bullish wedge, flat top, and it is not a triangle because there isn't a vortex. So wedge is exploited at the breakout of the upper trend line. So there is of the upper trend line. So it's very important to know the difference between triangles, wedges, and pennants. So in this example, you can see a successful retest of this wedge of the upper line, and the price proceeded to go up. So this is a bullish wedge. Remember this pattern, as this is a bullish wedge.
Great stuff there. All these charts that we are seeing, Tarantula. That's great. I just will add maybe I'll quickly go through this because I think that it's pretty clear.
Of course, please. Go on, of course.
We have basically, as Tarantula was already explaining, indeed, we have reversal and continuation patterns. Of course, we have then bullish versus bearish continuation patterns, just like we have bullish versus bearish reversal patterns. And a classical example, of course, is a flag, definitely one of the most commonly used, probably also my favorite, in fact. So, but other examples, of course, triangles, pennants, rectangles, indeed, and wedges. So the opposite is true, of course, for the bearish continuation patterns. That would be the bear flag. So here are a few more examples of bear flag on the Euro 1 hour chart. How you can see that typically a flag builds in its structure. You have an impulse which is usually quite short, and then the correction actually takes longer. As you can see, you can just look at the price action. For example, here the break lasting only 2 candles, and these are hour bars once again, and then the entire bull flag, I think it lasts, what could it be? It looks like, roughly speaking, a day or so. I would say 20 candles, and then again the break to the downside being 2 candles, 3 sideways, 1 down, and then eventually another 3 down. But you get the point that sometimes you do need a bit of patience with these flags before they break, and I wouldn't necessarily, expect sometimes a break, especially if it's expanded like this. You want to be cautious that the flag can sometimes take a little longer than you think. Here we have we have some examples of smaller flags as well. Very small ones. These are more like 15-minute flags, in fact, because especially this one right in here, right, very tiny, just 3 hours of sideways movement and a big continuation, and then a big bull flag at the very end. Reversals, you can think of course, something like a double bottom, inverse head and shoulders, and a falling wedge. Falling wedge is a bit tricky to trade, I believe, because sometimes you do get a last push up or last push down in the falling wedge. So those are tricky because when is the exact moment that we break? So that's why waiting for a breakout is, you have a bit more confirmation maybe, or especially if you break out of a resistance or support on the higher time frame. Bearish reversal patterns, the opposite, of course, for those. Here are some examples, some theoretical examples. It took me a long time to draw all these lines on here. Doesn't look that special, but it took me ages. But this is just to see the theory behind all of these patterns. At the top, we see flags, how they would look classically. double bottom. You see the gray line indicating the neckline. That's very important because then we realize that the pattern is actually materializing and the pattern is playing out, is unfolding, and is breaking support or resistance. The head and shoulders and the inverse head and shoulders, often enough, pay attention also to the fact that time is more or less equal here, the levels are more or less equal here, and preferably you want to see divergence between the top and the previous top. That would give more confirmation that the next lower high will actually be a resistance spot. If you don't have that divergence, I would say the statistics are less in your favor, less in our favor. So definitely with the divergence, a hook back to the same level as the left shoulder or a 618, 786 fib of the head to the second bottom, and here a fib are resistance levels. Then you see the rectangles and triangles already indicated in a lot of our examples. Okay, so let's move on. This is the euro-dollar daily, and you can see classical example. I actually took this one because I sold it right at 132.80. It's a long time ago, but it was really the top of the tops when we got a 1,000 pip fall. So still one of my nicer trades out there based on this daily chart. Contracting wedge. This is funny enough a 1 minute chart. So you can see them really everywhere. Not that I would necessarily advise you to use a 1 minute chart to trade right off the bat, but just to indicate that the market is, is similar in its movement and nature, and they all fit into each other. All these minute bars basically make up the 5, and then they make up the 15, and etc. up to our weekly and monthly charts, right? So you can see here that impulse relatively on the 1 minute chart, and you can see here the wedge and continuation. That was yesterday, I think. Expanding wedge example in the double bottom where price is, this is a 4-hour chart. We had a pretty massive move down here, in fact, all the way from 137 falling to 129.50, and we kind of get a choppiness. Now, I'm sure there are different ways of looking at it. You could probably see many patterns in this. This is one way of looking at it. You probably could see a trend line like this as well. So it depends how you look at it. This is expanding wedge, where the tops are broken, the bottoms are broken, and wave E can end anywhere. It could end at the top, but it could end earlier as well. I'll just pause. Oh, the person has left. Okay. Double bottom example. I think it broke the bottom maybe by a few pips, but we had a closing reverse after that. Classical double bottom example of April this year. So we've shown some nice examples of chart patterns, but in some cases, these chart patterns are going to be not breaking in the anticipated direction. So, for example, here we have a classical move down, impulse, correction, impulse, and slowly but surely price moves up. And you can see how corrective that is compared to the impulse to the downside. The impulse to the downside is the trend. The trend is to the downside. You can see the moving average also pointed to the downside, by the way. And the upside is corrective and slow. That's typical. If it's making a correction, it will not go fast. Eventually, when this flag pattern has built and finished, you will see a break right in here. And this bear flag is technically breaking to the right side and is breaking the bottom of the bear flag, hook back, and continuation to a next low. So that's a nice break. Now, sometimes some of these flags, in fact, turn into a trend. This is a 50-minute chart, so I wouldn't be worried about that. But on a 4-hour chart, in some cases, if you have a strong move down and you, in fact, start doing something like this, which looks like a bear flag, and you start to put a line on the tops and a line at the bottoms, sometimes in fact this does not turn out to be a bear flag because it's a 4-hour world, and instead of breaking to the downside, you actually see an impulse breaking the top line. So that's why, especially on 4-hour worlds, I wouldn't recommend it on 15 necessarily, for example. Then you definitely want to wait for a break in the direction of the trend. But in this case, in fact, the 4-hour world would indicate a trend change if you break the top line. So with 4-hour or day charts, you can actually put lines on top and bottom and wait for either of the break, because the break here would indicate the downside continuation or the upside reversal. That's on the 4-hour world. This is the 50-minute chart, so let's go back to our examples here where we have actually an impulse, for example. You have a triangle, but we actually get an opposite break. But that's quickly and swiftly finds support and then does make that upside. Then we have a bull flag, but this bull flag isn't broken to the upside, but to the downside. All right? And then we still get a bounce because in the meantime we have a support trend line, and that's being used by the market. So we bounce off that line, so you can see that not all these patterns will break to the desired direction. That's why it's good to wait for the breakout, because then we have the confirmation of the pattern unfolding in our desired direction. And sometimes it doesn't happen. I mean, these are all statistics. I would say, what is it, 75, 80% or something like that, these patterns break to the side we want it. Just a rough guess. I never really counted them. And of course you have the occasional that go the opposite way. Then in the meantime here, the green line is indicating actually a bigger triangle, because that's the formation that the currency now is building. And this one we do break to the upside. You can see here where I have the green circle indicating the break. Then we make a bull flag. This too, it's a break, hook back, continuation, and then another bull flag, and another break, and then another rectangle, in fact, after the bull flag, and continuation. So these patterns really, they're everywhere. They are very important for reading market structure, for understanding the psychology of the market, understanding why the market is doing what it's doing. The market is going to be moving at certain times, but mostly it's going to be correcting. And you can see that not many of these candles are really impulsive. A lot of them are corrections. So if you understand in what phase of the market you are, in what phase you want to trade, and what is most profitable to trade, then you can be better in timing your trade. So this is being recorded, by the way. And the EMA that I'm using here, I'm not sure. It looks like it's could be a 20 or 34. It's hovering price pretty closely, so I don't think it's more than that. So what are you looking for to actually enter such a formation? Where do you make that decision if price is breaking out to enter? So you have certain methods of entering to breakout, or maybe even early entry. You could also actually, what I didn't mention here, didn't think about it, but you could also wait for the breakout, wait for a pullback and take it on the pullback, or not even the pullback, but wait for the next breakout, which is the continuation. Tarantula and I have been talking about it in other webinars where you have, for example, let's say a triangle like this after an up move, and instead of taking the first break, well, let me draw that in a different color so you can see it a bit better. Instead of waiting for the first break, you could also wait for the pullback and the hook back, basically. That's represented by the P, or even wait for the C, which is the continuation. Right? So one of these three, or maybe even a combination of such, if you keep an eye on the risk management. So the entry of the breakout would be when the actual formation is being broken. That means price is pushing through that trend line and pushing through the tops of a nearby resistance or support. The stop loss could be, depending on on the breakout, it would be on the opposite side of the pattern. If you take the continuation, it would be below the lowest support. So if we have, for example, this upside triangle, breakout would be under the pattern, the pullback would still be under the pattern, and the continuation could be a bit higher, right? That would be under the bounce. The targets are basically you can measure the length. We'll talk about that a bit more detail. I think I have a separate slide, in fact, but okay. Just quickly, I'll dive into that longer. You can measure the impulse and then add that measurement to the end of the correction. And they could be equal to each other, for example. So those are breakouts, but you can in fact add pullbacks and continuations, but you could also try, for example, in a contracting wedge, if you have an impulse like this, and you have a triangle like that, and the triangle bounces, for example, at the top here, at the bottom, at the top, at the bottom, at the top, at the bottom. A bit more riskier, but then again, better reward to risk is if you would maybe try sneaky along at the bottom, right in here, we have the arrow, trying to catch basically the support trend line bounce to the upside and hope that it this time breaks instead of bounces back, right? This time around, hopefully it breaks instead of one more bounce. And that is possible, but you want to make sure that realize it's more risky, and you want to trade it only in the direction of the trend. So if you see an impulse to the upside, you want to take the bottom. You don't want to concentrate on trading the top, because trading the top is risky in the sense that this time around the currency could actually break through the top line and not bounce, and you just are stuck there. So you want to be aware of those risks. Some tips for breakouts. What I often do is if I have a trend line, for example, the 1 hour chart, and I have an up move, I see an up move, and I see a flag like this building, what I do is I put a trend line, of course, on the top, like this. This is a 1 hour world, mind you, 1 hour. And I see the next bounce, well-established bull flag. And if the price is coming close to that top of the bull flag, then I zoom in one time frame, and I'm looking for a fractal which is going to hit the top of the 1 hour trend line, but on a 50-minute world. So I zoom in, and instead of waiting for how do you measure that break of the trend line, I use the one time frame lower fractal and a break of that fractal and a break of the trend line, because they have to be at about the same spot, and that's where my actual entry is for the upside. So I zoom in one time frame. Once I'm in, I want to go back to the same time frame because I want to see what kind of candlestick arrives when we have a breakout. So when we have the impulse, we have a triangle, and we have a breakout, I want to look at that 1 hour candle, and if it has a major big wick, then I might know that it's a false breakout, and I could try to exit that trade at break even. If it's a candle which has a close near the high, then I know that the likelihood of a sustainable break is decent. So by using price action and candlestick formations and readings on how close the close is to the high, I got a pretty good idea what happened in that hour and what the psychology was of that candle when it broke out. And based on that, I know if it's sustainable or not. And sometimes you do get a wick and still the trade continues, but I know that the statistics are then decreasing, so then I rather get out, basically. Euro New Zealand happened, I think, on yesterday. It was a breakout, and there was a big wick, and I just got out. And what happened was that we had a big triangle. In fact, after that wick, because we had a wick here, like this, and we made a newer triangle, something like that. And in fact, later on, we broke to the downside. So it's good I got out of that one. Early entries. As I said, look for longs close to support or shorts close to resistance, but make sure that you understand what the trend is and always trade in that direction. That's the preferred method. And then you could scale in on the breakout. Some examples, 1 hour chart. The green line indicates the corrective trend line. The trend line is at a decent angle. It has 3 touches. And the 4th time around, we're approaching it, and as you see, we're breaking through it. But when we break through and we look back at our 1-hour chart, we see a massive wick. That's not a good sign in my opinion, so I'll be very leery of the trade. Now in this case, I gave on purpose an example that actually did materialize. Nothing is a guarantee. Nothing is a guarantee. So despite that selling pressure in that hour, the up move, the support continued for the upside. Let's look at another example. Right in here, we have a break of this purple line, I would say. But the break is accompanied with 2 bullish candles. So that's a good break. We do have a rejection bar after that, but still continue to the upside. Some examples of sustainable breaks. In this regard, you can see the currency moving up like that, and we're making a ascending wedge, which in this case is a continuation pattern because we're in an uptrend, and the tops indicating maybe not the willingness to break as yet, but every time the price moves down, people are willing to buy it at a higher price. So that's the psychology of this formation. People are leery of the tops, but they're gladly buying it at a higher spot because they're anticipating the break to the upside. And that's what happened. And if you look at that formation, you've got a good 1-hour candle above it, and another smaller bull flag, and then yet another continuation, hook back and continuation, and the currency stays also, one more thing, stays above this top. Look at that. So that was a sustainable break of an ascending wedge, but also of a flag, bull flag right in here, and a good break to the upside. So I actually zoomed in. So let's take a look at those examples. What I did was, this is the 1-hour euro dollar, but what I did was I zoomed in on a 50-minute chart into this area. So you're going to see these 2 examples based on the 50-minute world now. And you see the ascending wedge right in here, very clear. And you can see that the entry would be upon the 50-minute fractal, in my opinion, right in there or there, and the next one even here of the smaller bull flag for an add-on maybe. And the next bigger bull flag, as you can see, we had 3 touches right in here and here and here. And upon the break of this 50-minute fractal right in here, we got that continuation. So we're going to talk a bit about advanced chart patterns a bit more.
Yeah, let's make a small break. With those patterns analysis. Now we can talk just about, and we can continue to talk about some advanced chart patterns. So again, we need to see head and shoulders, inverted head and shoulders, megaphone, or broadening top, diamond, and W1 to 3 and M1 to 3 patterns, which are basically reversal patterns. So all of those patterns are reversal patterns. Head and shoulders and inverted head and shoulders, especially, are very common. Megaphone can be traded both ways, and it's very hard to trade. Diamond is one of also the hardest patterns which can be traded, and W and M patterns are just as good as head and shoulders and inverted head and shoulders. So we can see it on next examples. So head and shoulders, you can see it. This was one of my analysis, and after the breakout of this trend line and neckline, I know that the target zone has been achieved. So what are head and shoulders? Head and shoulder formation occurs usually when the price trend is in the process of reversal, either from a bullish or bearish trend. If it's a reversal from bullish trend, then it's head and shoulder. If it's reversed and it's close to resistance, if it's close to support, and if it's a reversal of bearish trend, it's called inverted head and shoulders. So head and shoulders formation consists of a left shoulder ahead and a right shoulder. And the biggest thing is a neckline. That is a line drawn as a neckline. The left shoulder is formed at the end of an extensive move during which volume is noticeably higher. And after the peak of the left shoulder is formed, there is a subsequent reaction and prices go down usually to a certain extent, which generally occurs on low volume. Then the prices rally up to form the head with normal or heavy volume, and subsequent reaction downward is accompanied with lesser volume. Then we go to right shoulder, which is formed when the price move up again but remain below the central peak called the head. So you see the central peak, it's called the head, and we don't want the right shoulder to go above the head. So we want the shoulder to stay below the head. Then we have a neckline. Neckline is drawn across the bottoms of the left shoulder, the head, and the right shoulder. When prices break through the neckline and keep on falling after forming the right shoulder, that is the confirmation to go short. So we want the price to break out of this trend line and retest the trend line and go lower. So the target prices are usually the complete length of head and shoulders pattern. So we can estimate the target price also by measuring the distance between the head and the neckline, and we can add that distance to the bottom of the neckline. Yeah, this is the distance and this is the distance. But why I had this analysis target zone? Because that was very, very important numbers. And after the move, we can saw that the price is indeed retested 28, 35. It was retested, but the target zone was, for me, was more significant than the complete length of head and shoulders. We only use a complete measurement of head and shoulders if we want to potentially take the full profit, but I never do that, because in these market conditions it's very hard to make a full profit of a particular pattern. So I'm more watchful and more based on levels. In this example, we can see that the price has retested 28.40, and then it made an inverted head and shoulders within a bullish wedge. First, let's see a bullish wedge, the lower trend line, upper trend line, and then we can see a left shoulder, a head, and a right shoulder. We have a trend line, and basically after the break of that neckline, the price, and indeed it was a successful trade, the price went up to 29.30. So inverted head and shoulders are just the opposite of head and shoulders, and they are both traded within the break of the trend line. When the neckline is broken, we can trade it successfully. Draw neckline of the pattern, that represents a support level. So head and shoulders formation is not completed unless it is broken. So we need to observe carefully the breakthrough of the neckline. So that is very successful pattern if we know how to use it. So always wait for the neckline and then trade it. This is one of most, maybe the hardest pattern to trade, and I usually don't trade when I spot this. This is broadening top or megaphone. It's characterized by converging two trend lines, but they converge in a shape of megaphone. So it's very hard to trade. Usually it's traded between those trend lines. In this example, we can see that this was a breakout of the upper trend line, so the megaphone was invalid. But usually what happens is, you can see how the price bounced off until it was broken. It's very hard to trade because the range of the megaphone is very high. The biggest and most significant support and resistance levels are very distant to each other, so it's very hard to trade. I don't recommend trading megaphone pattern. I just don't do that. Broadening top or megaphone, it's usually a bearish pattern, but I never trade it. It's very, very hard. So that is my view for megaphone. This is diamond pattern, and this was a good example of diamond pattern because in this example we can see an entry. The entry is at the right arrow of this diamond pattern, But before we can see how entry is made, let me just tell you a few things about diamond pattern. Diamond patterns are very rare, but they are profitable. But you know, again, I don't trade it because they are a combination of broadening pattern and a triangle. This pattern doesn't have to be completely symmetrical. They can occur after the price rise or after a descent, regardless of when they form. The breakout can be in either direction. So sometimes there is a pullback or throwback after the breakout. A pullback is when price retraces from a break downward. A throwback is called when the price is retraced after a break upward. We can see a break downward and a pullback at this red arrow. This is a diamond pattern, and this is a short entry on diamond pattern. This can be traded either as a breakout or wait for a retest. Very hard to trade. It's a combination of broadening top and symmetrical triangle, and I don't recommend trading it. Stop loss is usually placed after the last swing high. So we don't go as a stop loss for the full swing high on this example. We can see a red horizontal, small red horizontal dash. That is stop loss for this trade. So if you want to trade diamond pattern, you can memorize this picture. This webinar is being recorded, and it will be uploaded. So this is a perfect example of diamond pattern. This is a good example of shorting into the diamond pattern, and the stop loss where the red dash is at the right upper corner of this diamond pattern. So if you ask me, I wouldn't trade this. This is very tricky for me, and as always with megaphone patterns, they can be real nasty if big boys decide to do at their bidding. So this is one of my favorite patterns. This is called W123 reversal. W pattern, as we talked on our some of our previous webinars, W reversal is pattern usually formed in close to support. It signals the reversal, and after the break of this second point 1, 2, 3, and at the break of 2, second point, in this example is 31.15, we can trade a successful continuation. So again, this second point and the highest point in 1, 2, 3 reversal is this second point. We draw a horizontal line, and after the break we trade it. So that is W pattern. It signals the reversal from the support. We can see the trend line here, we can see a W, and if that happens, that 31.15 is broken, that means that the price will 70% of the time go up. And those can be real successful patterns if you know how to exploit it. And I think last one to show is M pattern. M pattern again is M. Basically it's a reversal of W. It's in M shape. 1, 2, 3 again. As in W1, 2, 3, the second point is at the bottom of M. So we wait M to appear, and then we wait for the candle to break through and retest. This retest has been, this is a successful pattern, but the retest has gone a little bit to the upside. That can happen from time to time, even if your analysis is alright, and even if your entry is good. Still you can exploit, still you can suffer from a loss, because usually there are some stop grabbing patterns. In this example, there was a stop grabbing after the successful break of the second point, but eventually the price went down, retested, and proceeded with big momentum to the downside. It was almost 600 pips. So you can see how good that pattern is if it's close to a resistance. So there is a natural explanation for this stop hunt, because this is very close to a resistance. You can see that big boys stop hunted the weak stops and then reverse the price in a good direction. So that can happen just preceding and prior to big move. So M pattern is also one of my favorites if it's very close to the support, like in this example. Right, Chris?
Exactly, indeed. Great stuff here. Well, we already talked about the take profits indeed already a few times. So basically, it's the distance from the head to the neckline and then subtracting that distance. So these are some targets that you can think of, but you might also, of course, definitely want to take a look at other support and resistance levels that could influence the markets because the pattern might fall short at those levels. So definitely be careful of that. Measuring from the neckline is one way of doing it. I also heard traders talking about the starting point of the neckline, so maybe that's a bit more conservative method, but in any case, that is just an indication, of course. You can also use fibs and Fibonacci targets and expansions for your targets as well. The best is to look for confluences. Those are always the best methods for finding the best target and take profit. So same for the flags, basically, as well. We can measure that distance from impulse to top and then add that to the correction. For example, like this is an example of the Eurodollar 15-minute chart, and as you can see, it's more or less roughly the same, 73 pips, and the second one is 66. So just a tad difference there, so beware of that as well. It's just a general guideline, of course, although it's pretty close. So this is a bit of a pop quiz here for all of you actually, to test how much you know or have learned or recognize. Right, Tarantula? This is a bit of a quiz here for our audience. Let's see how many answers.
Yeah, let's see, guys. How many patterns I can see? I can see a lot of patterns here just by looking at the chart. I can do it by naked. Blind eye.
That doesn't surprise me. This is the Eurodollar 1 hour chart right away.
Oh, yeah, Eurodollar. I'm seeing it every day. I'm really. I dream of it.
Yeah, you stole my words. I wanted to say the same. Tarantula is dreaming about the Eurodollar 1 hour chart. No answers so far. We're gonna give some time here, huh?
Guys, I think that this is not too hard. You can spot them. You can spot also flat top, the flat bottom descending triangle. You can see some flags here. It's really easy. Look at this downtrend. You see? Bearish flags, 2 bearish flags after the breakout, 1 consolidation rectangle here. Okay, we have some answers.
Yes, Stefan thinks 6. That's the first guesstimate. Anyone want to alter that view? Unfortunately, I don't have any winners for the prizes. You get the winner gets a full recommendation of the chart pattern award-winning recognition. We have, well, Stefan, you're going to be the winner if it stays like this. You'll definitely be the closest. Maybe you're already a winner. Maybe it is 6. Yeah, we definitely see some setups here, right? We got some more answers. Just that you know, we have 8, 7, and 4. So I have the next slide where I have what I saw. Maybe there are more even. I just quickly drew what I thought was appropriate, but maybe Tarantula could add a few even. Who knows? We'll see in a minute.
Let me see. I didn't chart it, but I can see it naked. But let me see your answer.
How should we move on? Let's move on.
Yeah, let's move on. Yeah. 1, 2, 3, 4, 5, 6, 7, 8.
Let's see. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. I had. Because
12.
I'll show you what I did. I had the green ones here, double top.
Ah, you counted it. Okay.
Yeah. Then the purple ones are like the head and shoulders here.
Yeah, that is definitely head and shoulders.
Maybe an inverse head and shoulders here, but iffy maybe. Let's count it as a half one. Maybe an expanding wedge here. Those are always a bit difficult. And then some flags and triangles, basically. Maybe, depending on the price action before that, in fact, maybe this. I didn't think about it, actually.
Well, mostly you got it right, Chris. This was... Well, that's it, yeah.
That's about it. So, yeah, quite a lot. Definitely around 10 or more. So Asia Sard is the winner with, who said 8. Congratulations there. Well done. And thanks for the others for participating.
Yeah, well done, guys. I think that you need to practice this. So always go from your right to the left of your charts and try to find those patterns. So this is, I don't use any indicator for this. And I think that by screening time, you can really become a master of chart patterns. Even if you don't use it in everyday trading, it can help you. Coupled with some confluence with Fibs or some indicators you use, it could be quite helpful. So if you don't want to trade naked, go with stochastics or with some confirmation indicator which you use. It can be an edge in your trading. Definitely.
Great stuff. Maybe some questions still that we can answer, if
there are some questions.
Don't forget that there's going to be a live webinar again on Monday.
Yeah, and my webinar also on Monday for new traders.
Yep, exactly. And then, of course, on Tuesday in the morning, we're going to take a look at swing trading. I will be back next week as well, of course, same time, same place.
So guys, if you don't have any further questions, thank you for listening to us, and I think that just by practicing you will be a great charting traders. So pay attention to these webinars. If you're not sure again what you were hearing from us, try to watch the uploaded webinar again, and if you have some questions, you can also ask me on my blog. I have a personal blog, if you don't know, on Admiral Markets Global site. I think that it will be active again in next few days. So if you have any further questions, don't hesitate to ask.
That's great stuff. Don't forget to take a look at the Admiral Markets in social media, Twitter and Facebook, for example. And this investment game. Once again, Admiral Markets sponsored this great webinar. And there's a lot of webinars that you might want to take a look at besides this one, because we have them archived. And you can take a look at those by, I'll just show you actually, it's a lot easier, by going to admiralmarkets.com, click on education, go to webinars, and then live webinars you can sign up first of all, and then if you go to the video archive you can see all the topics that we've discussed. So in all honesty, I don't think really you don't need much besides this. I think if you go through all these webinars, you already have a very strong, I should say, foundation, sorry. And then it's all up to implementation and screening time as well, of course. So that wraps it up, I guess, for today. Thank you for joining us today, and looking forward to see you next week.
Yeah, thank you very much, guys, for attending, and see you soon. Bye-bye, and many green pips.
Good afternoon, ladies and gentlemen. I welcome all those of you who decided to stick with us. I will now take the presentation over from Nat and Chris. Thank you very much, guys, for the great webinar today. My name is Mikhail Olahov, and I'm a client relationship manager for Admiral Markets. In essence, my job is to create the best possible trading environment for you guys. I see that the amount of participants is growing, and we do have a lot of people who attend those webinars on a constant basis. It is very pleasant to see that. It is great to see that a lot of our traders do not stop and carry on their education trying to make tomorrow more profitable than today. Really great to see that, guys. When you work for a financial company like I do, you get to meet a lot of different people who are interested in finance. You meet traders who have been trading for years. You meet people who are just making their first steps in the market. You get acquainted with successful traders and the ones whose profits, well, are not as high as they could have been. I always wondered what separates a successful trader from the rest. If you analyze the field, you reach a conclusion that a great, stable results are not down to the strategy implemented or even intellectual capabilities. Both of those factors are important, but there is something else that should be considered. After all, the things you should know to be able to be a good decision maker in Forex are difficult, no question about it, and this is why we have those great webinars to teach you them. But of course, the concepts are not impossible, and I'm sure that every single one of your traders could have seriously improved their overall trading results if they tried hard enough. I'm convinced that a lot of our traders must go beyond learning about the variety of trading techniques and should also approach their trading from the motivational and psychological side. It is fairly simple to measure your success in trading. If you're profitable on a constant basis, you are a success. If you make losses, you're not successful. In this slide here, we have Angela Lee Duckworth. She has conducted a very interesting research in the United States. She studied people in challenging environments, and the aim of the study was to determine who was successful and why were they successful. She studied teachers, army personnel, and salespeople at multinational corporations. At the end, one key characteristic emerged. It was not good health. It was not good looks. It wasn't even your IQ. It was grit. Grit is passion and stamina towards your long-term goals. Grit is sticking with your future day in and day out. Not for a day, not for a year, but for a long, long time. Grit is living a life like a marathon, not a sprint. Here you see a picture. This is the start of a London marathon. You see tons of people who participate in this marathon every year. This is a picture of a finish. A finish line is always almost empty. Not a lot of people who start a marathon are destined to finish it. And the importance to know why some finish and some don't is the same reason why some people are successful in Forex and some are not that successful. To me, the most interesting thing about grit is how little we know about it and how little we try to learn it. How do we get ourselves motivated and have the strength to follow through with our commitments? I would like to have an answer to this question, but the truth is that no one knows how to train yourself to be gritty. So far, the best idea is being now developed in Stanford University. On this slide, I have the name of the research for you. It's very interesting. It's fairly new. It's only been published in February 2013. You can go online, search for it. It's really great. It's about how to teach grit to young children. But the most interesting part about this research is that it shows that your ability to learn and analyze, and that is pretty much what Forex is all about. It's learning and analysis. The ability is not constant. It changes with your efforts. The more you try, more things you do to get better, for example, trading, grittier you become. More time you trade, more time you learn, you become more grittier and you're able to absorb more and more knowledge. You become a person who's a lot more likely to persevere even if he fails. So I wanted to let you know that a failure is something. It can be anything in life, not only Forex trading. It's not attributed to your talent or your intellectual capabilities. It's your lack of grit. If you fail, it just means you are not trying hard enough for a long enough period of time. So when you choose something as your goal, as your aim, you have to put continuous effort into achieving it. So for all of us here, we use Forex as this tool. We want to use Forex first to secure an extra source of extra income, and then possibly as a path to total financial independence. I'm pretty sure all of us have those plans. First, you start with a little bit of money, and then you move on to better things. You become totally financially independent. And that is a great future we have imagined for ourselves. Many of us fail, but we fail not because of the economy. We don't fail because of the broker. We don't fail even because we're not smart enough. All of us are smart enough. We fail because we do not have the grit to follow through on the dream every day and every day and every minute and every second, day after day, month after month, year after year. We fail because we fail to come through with our plans. Now, this is why I spoke about people who attended this webinar on a constant basis. You are getting there. Keep learning. Keep doing things better that you would have done them yesterday. Success and everything that comes along with it is reachable. All you have to do is work towards it every day for years and years. Do not give up. If there is something that I want you to take away from this presentation, is this simple thing. If you try hard enough, you will succeed. Thank you very much for listening to me today. I will see you guys again on Monday. It's been great having you and speaking to you on Thursday. Have a great weekend and good luck for us. Thank you very much for your attention, and I'll see you again next week. Bye-bye, guys. It's been Mikhail Olakov. Once again, I'm available on all social networks, email, phone, Skype, LinkedIn. Search me up. I'll be happy to talk to you guys. Thank you very much for your attention, and have a good weekend. Bye-bye.
The organizer has ended the